Good morning and welcome to Financial Accounting. We are fully on Zoom today due to the weather. And so this is, for some of you, you're accustomed to attending on Zoom. For others, you've been mostly or fully in the classroom. So it's going to look a little bit different maybe, but certainly if you have questions, you should feel free to unmute and ask questions. And if you are more comfortable just using the chat, you can do that as well. So looking at our schedule, we know that today is our final class day before the Thanksgiving recess, so no classes at all next week. Today we're going to be finishing up chapter 12. We will pick up with exercise 6 in chapter 12 in just another minute. And we'll finish up the chapter, and as soon as we finish the chapter, we will be done for the day. Remember, you do have an exam due this Sunday, and I've been encouraging you to complete that before you leave for Thanksgiving recess. I think that's probably a better plan for most people. We did have a review session yesterday morning. There were a few people in attendance, and so that was recorded, and that recording is linked in the reference materials folder in Brightspace. If you scroll down, the link to that video is just after the chapter 11 reference materials folder. We did go through the entire practice set in that review session, but we didn't go through in order. So one of the people who was there had a limited amount of time, and she was asking specifically about some exercises from chapter 11. So we did those first, but then we just cycled back to chapter 10. Excuse me, and so all of the exercises are on that recording, just not in order that they appear in the practice set. So I would encourage you to use that to prepare for the exam. And of course, if you have questions about that, you're always welcome to ask, but I would first refer you to that video. Then also on Sunday, the fourth part of the Real World Annual Report is due. So please make sure you submit that again before you take off for Thanksgiving recess. Okay, so after today, our next class meeting will be November 29th. At that point, we will have just a couple weeks of class left. The first week after Thanksgiving, we'll cover chapter 13. Then the second week after Thanksgiving, we'll cover chapter 14. And I think I said in class on Tuesday that our last official class day is December 13th, but we will not be having class on campus. We will have an open review session, and that will be strictly on Zoom. So if you have questions, if you want to go over anything, if you want to work on that practice set, plan to attend Tuesday, December 13th on Zoom only. All right, so any questions about what's coming up or anything else before we go back to chapter 12? Anything you want to talk about from chapters 10 or 11? So those are the two chapters that are on this weekend's exam. So it's important that you're up to speed with those. Any questions from chapters 10 or 11? Okay. Well, let's go to chapter 12 then. And here's my starting slide. There it is. So on Tuesday, we introduced chapter 12. We talked about the intricacies of issuing stock. We talked about how it's recorded, par value or stated value or no par stock. We talked about issuing stock for cash and for other assets. We then talked about dividend policy and the function of the board of directors related to that dividend policy. We looked at one exercise where we talked about the 3 important dates related to dividend policy that we are, once the board of directors meets and declares that dividend, it becomes a legal liability of the company. And so we need to record that as a liability and record the cost of the dividend. And then we need to, a few weeks later, we have the date of record that determines who's going to receive the dividend. And then finally, we have the payment date where we actually send out the checks for the dividends. We also, at the end of class, we were looking at the concept of cumulative dividends on preferred shares and what that would mean for companies that maybe didn't declare enough dividends to cover the entire obligation to their preferred stockholders, how that would create dividends in arrears that would carry over to future years until they were fully paid off. Any questions about where we are at this point? Anything from exercises 2 through 5, any of the concepts we talked about from chapter 11, or excuse me, chapter 12. Okay. So we will move on then. And our next topic then is stock dividends, as you can see on the screen. So what we talked about last week, or last class, excuse me, was the idea of paying dividends in cash. Stock dividends is a very different concept. So the idea of stock dividends is really to give a reward or a thank you to our shareholders for investing in the company, but for some reason we are maybe unwilling or unable to pay a cash dividend at this moment. And so when that happens, when we when we can't pay a cash dividend, we may choose instead to offer a stock dividend. And so as you can see on the screen, the stock dividend does not change the assets or liabilities or the total equity of the company. But instead, it increases the number of shares that are outstanding, but everybody who is a current owner of the company is going to retain their same proportional ownership in that company. Okay, give me 1 second here. So the company may want to reward their stockholders for being invested, but they are unwilling or unable to pay that cash dividend. As we said on Tuesday, the board of directors can't declare a cash dividend unless they have the cash available to pay that. And maybe the company is either having a liquidity issue right now, or they have more profitable uses. They have something to do with that cash to expand and grow the business, or to continue to run the business in the same way that they wish. And so instead, the company can declare a stock dividend. Well, there are 3 different types of stock dividends. There's a small stock dividend and a large stock dividend. And then there's something that's a little bit different called a stock split. So a small stock dividend would be anything less than 25% as the dividend, and a large stock dividend would be 25% up to, but less than 100%. And a 100% stock dividend is really a stock split, where it's a 1-for-1. You had 1 share, we're going to give you 1 more. So we'll talk about stock splits separately, but our first exercise for today is about a stock dividend. So with this in mind, let's go back here to our first exercise. So again, this is exercise 6 for chapter 12, and we're going to be looking at entries for stock dividends. Recording. Okay. So entries for stock dividends. Healthy Life Company is an HMO for businesses in the Fresno area. The following account balances appear on Healthy Life's balance sheet. They have common stock. Remember, we talked about on Tuesday the concept of authorized, issued, and outstanding shares. Then they have some paid-in capital in excess of par and retained earnings. The board of directors declares a 5% stock dividend when the market price of the stock was $18 per share. Healthy Life reported no income or loss for the current year. If no entry is required, select no entry required and leave the amount boxes blank. If an amount box does not require an entry, leave it blank. So the first thing we're asked to do is journalize the entry to record the declaration of the dividend. And so what you need to understand is for stock dividends, we also have those three important dates: the declaration date, the date of record, and then the distribution date, which is the same concept as the payment date for cash dividends. This is a 5% stock dividend. So based on what I just told you, this is a small stock dividend. For small stock dividends, we report them based on the market value of the shares at the time the dividend was declared. Let me put this. So for a small stock dividend, great stock. For a small stock dividend, we use the market value as a proxy for the value of the stock dividend. So we know, if you think about what maybe you know or can understand about economic concepts, if we put more of something out there, if the quantity supplied becomes greater, the price is going to fall, right? So if there's a lot of something available in the market, it's not going to be as valuable. It's going to be much less expensive. So we know that when we put more shares out in the market without actually changing the company, so we already said if we issue a stock dividend, it doesn't change anything about the basic structure of the company. Assets, liabilities, and total equity remain unchanged. What happens, if anything, is a redistribution within the equity accounts. So, and that's what we're going to be seeing in this exercise. So we know that if we put more shares of stock out there without actually increasing the value of the company, the price of that stock is going to fall. There's a larger number of shares that are sharing in the value of exactly the same company. So we know that the price is going to fall. But our general rule is, if it's a small stock dividend, we're saying it's not going to have an appreciable or material impact on the value of that stock. And so that's why for a small stock dividend, we can use that market value as our proxy for the actual value of the stock dividend. If it's a large stock dividend, we know that that is going to have more of an impact on the market price. Remember, a large stock dividend is between 25 and 100% as the dividend. And so we know that's going to have a greater impact on the actual market value. And so we don't use the market value as a proxy for the value of that stock dividend. Instead, we use the par or stated value. And we'll see for a stock split when we get to our next exercise. So our next task then is to determine, well, how many shares are we actually talking about here? There are 3 million shares authorized, but there are only 2.2 million shares issued. And so just like with a cash dividend, we don't pay dividends on shares that have never been issued. So the 2,200,000 shares is the number that will receive this stock dividend. And the dividend is going to be 5%. So for every 20 shares you own, you're going to be given one more share. If you own just one share, you now have 5% of another share. So 5% of 2,200,000 is 110,000 shares that will be issued as a part of this stock dividend. So if this was a cash dividend, we know on the declaration date, what we do is set up the liability to pay this dividend. And we do the same thing on the declaration date for a stock dividend. So we have to report the cost of that dividend. And this is where the market value is going to come into play. 110,000 shares we're going to issue, and we assume that the value of that each share is $18 because that's the market value at the time that this dividend was declared. So we know that the value of those shares is actually going to come down a little bit, almost certainly, but we're saying it's close enough. 5% dividend isn't going to really have a material impact on that price. We're just going to use $18 because we have an objective source for that information. That's the market price for this liquid stock. So the value of this dividend, again, we're using the market value. And so we report the cost or the value of this dividend as $1,980,000. If we were distributing this stock, if we were selling it at the time that we sold it, we would put into the equity accounts, we would put the common stock and the additional paid in capital. But remember, we're not actually distributing the dividend on the day it's declared. We still have to go through the record date and then get to the distribution date. If you remember on Tuesday, I told you that the common stock account must always have in it the number of issued shares times the par value. And so if these shares haven't been issued yet, we cannot put the par value into that common stock account because this equation that I just put here on the screen would no longer be true. So rather than putting it in directly into the common stock account, we are going to use the stock dividends distributable, or sometimes you'll see it called common stock distributable. And that tells us we now have an obligation or a requirement that we're going to distribute that stock when we get to the distribution date, but we haven't done it yet. So that's what that means. And that's where that common stock distributable or stock dividends distributable, that's where we are going to put the par value. So we are told in the exercise, let me just scroll down, we are told that the par value is $15 per share. So we know we're going to be issuing 110,000 shares, and they each have a par value of $15. So $15 of that market value is going to be eventually going to go into the common stock account. But at the time the dividend is declared, we simply need to put that in the common stock or stock dividends, zero there, account. So again, that's the par value. And from what you know from Tuesday's class, the rest is going to be that additional paid in capital or paid in capital in excess of par. So that's the last $3. The market value of the shares was $18. Par value is 15 of that. And so the other $3 goes into the paid in capital in excess of par. So that's the first important date with a small stock dividend. If this was a large stock dividend, the cost or the value of the dividend here that's debited to stock dividends would just be the par value, and there would be no additional paid in capital. So if it's a large stock dividend, 25 up to 100% dividend, we would simply move the par value, and there would be no additional paid in capital piece to that. So we have the declaration date here. We report the value or the cost of that dividend. And then we go to the record date, which determines who's going to receive those stock dividends. And then we get to the distribution date, which is really the same thing as the payment date for a cash dividend. And on that distribution date, we're going to distribute the stock. And so those individuals who own the stock on the record date are going to receive their new shares. So 1 share for every 20 shares that they already own, or 0.05, sorry, 0.05 of a share, 1/20th of a share if they just own 1 share. And so we are going to move that stock dividends distributable into the common stock account, because those shares have now been issued, and based on our formula for what's in the common stock account, number of issued shares times the par value, now that we're issuing those shares, we need to move that value. It's no longer distributable, it has now been distributed. Questions about recording those dividends, stock dividends? Again, the only difference if this was a large stock dividend is it would have been recorded at, in this case, $1,650,000, and we would omit this additional paid-in capital piece. Everybody's good? Okay, so let's move on to the next part then. Determine the following amounts before the stock dividend was declared. So our total paid-in capital, and this is going to be based on the information that we have up here given in the problem. So $33 million was the par value for the outstanding shares, plus 9 million more that was additional paid-in capital. So we're up to 42 million for the total paid-in capital. And then the retained earnings was given as 89,550. And so our total stockholders' equity before this dividend was declared, $131,550,000. We know from what we talked about in the PowerPoint before we came to this exercise that our assets and our liabilities remain unchanged when we have a stock dividend. If we know that assets equals liabilities plus equity, and we know that 2 of those 3 numbers did not change, then our equity also does not change. What does change is the amount that's reported as retained earnings, and then the amount that's reported as paid-in capital. And so what happened here? In total, what happened is we took this amount, and when we close our books, this stock dividends gets subtracted from retained earnings, just like a cash dividend would. So when we close our books at the end of the period, the stock dividends gets subtracted from retained earnings. And between these 2 pieces, that amount that gets subtracted from retained earnings gets moved into paid-in capital. And so the total value was $1,980,000. We're going to subtract that from our retained earnings. And that leaves us with 87,570,000. And at the same time that we're subtracting that from retained earnings, we're adding it to our total paid-in capital. And so the end result of this stock dividend is that we have moved value out of retained earnings into contributed capital. The amount we move is based on what type or what size that dividend is. And so we know right here that if it's a small stock dividend, we move the full market value. And if it's a large stock dividend, we would move only the par or stated value. So as I said, these are two of the three types of stock dividends. And in our next exercise, we're going to look at the third type, which is a stock split, so that we are receiving at least one full share for every share that we already have. Everybody okay with this one? Okay. Let me clear my drawings. And keep going. Oops. Okay. So our next exercise is related to stock splits. As I said, this is a special type of stock dividend where we are issuing at least 1-to-1. So it's a 100% or greater stock dividend. A stock split is accounted for differently, though. We actually do not move any value from retained earnings into contributed capital. The total dollar amounts remain the same. What does change is the par or stated value. And so if it's a 1-to-1 stock split or a 100% stock split, we now have twice as many shares outstanding, or we will once the split happens, and the par value is cut in half. So all companies have what they perceive to be the right price for their stock. So by right price, I mean the price or the value that they think that shareholders think that stock should be, right? So here's the price range that we think we should be. And so what happens is, we talked about Tuesday, as a stockholder, you want the price of that stock to be increasing. But if it's getting up higher than you think the actual underlying value of the company, you're going to see that increasing price slow down, kind of hit a ceiling, if you want to think of it like that. And so at that point, the company would consider effecting a stock split. We know, and economics tells us, if we double the amount of something that's out there, the price is going to come down. And the same thing is true for stock, just like it is for literally anything else you might want to buy. And so if the company believes that their stock is now being overpriced and the price is going to stop climbing, they will issue more shares to cut down that price intentionally. If you are an owner of the stock, your proportionate share in the company remains the same. And in a perfect world, if we double the shares of stock, the price should be cut in half. So your investment total remains exactly the same. But it's a good thing for you if the price then starts climbing again, where maybe it had slowed down or stagnated and you weren't seeing that growth in the value of your investment. Okay, and so this is an example of what that might look like. So before the stock split, if you had 4 shares and they had a $100 par value per share, that's a $400 total par value. In this case, they're suggesting the company did a 5-to-1 split. So we would expect the market price, if they do a 5-to-1 split, so you now have 4 more shares for each share you already owned. If they do a 5-to-1 split, then your total market value, so this slide is about par value, but your total market value should also remain unchanged, we would anticipate. So let's go to our next exercise. We should probably look at this. So we already know what happens with cash dividends. It decreases our retained earnings. The same thing happens with stock dividends. It decreases our retained earnings. But because we aren't paying out cash, our total equity remains the same. And so if our retained earnings decreases, then the contributed capital must also increase to balance that out. Now we can go to our exercise. Selected transactions completed by Canyon Ferry Boating Corporation during the current fiscal year are as follows. We're asked to journalize these transactions. So the common stock was split 2 for 1, and the par value then was reduced from $100 to $50 per share. After the split, there were 300,000 common shares outstanding. So I should have already pointed out that these stock splits or stock dividends cannot be done if the company does not have the shares available within their authorization. So remember, we talked about on Tuesday, when you incorporate, you get permission to sell or distribute a certain number of shares. Well, the company has to have those shares available within their allotment, within their authorization, if they're going to issue more with a stock split or a stock dividend. One of the topics we're going to be talking about very shortly here is the idea of treasury stock, where a company buys back its own stock from current investors. And so wanting to issue a stock dividend or a stock split might be one reason or one way that a company gets the stock that they need to be able to issue as a stock dividend or a stock split. They can buy it back on the open market, and now they have those shares that they can redistribute. So on January 8th, we split the common stock. We already discussed that there is no actual accounting change to our equity accounts. We don't move that value. If it's a stock split, we don't move that value out of retained earnings into contributed capital. And so there's no entry required except a memorandum that says, by the way, the par value of our stock has changed from $100 to $50 per share. So we had 150,000 shares outstanding, and now we have 300,000 shares outstanding after this split. So on April 30th, when we declared dividends, we declared 60 cents per share on the preferred stock and 22 cents per share on the common stock. And that's funny, there's a box missing here on the April 30th entry. Sure, that's just an oversight. We don't need it, but it should be there anyway. So let's figure out the cost of those dividends. We know on the declaration date, the dividends become a legal liability of the company. We need to report the cost of those dividends and report the liability, the dividends payable. So let's figure out how much we are actually declaring in total dollars. So for the preferred stock, we're paying 60 cents per share. And then for the common stock, and we know that there are 300,000 shares outstanding right now, we're paying 22 cents per share. So 16,000 at 60 cents is $9,600, and 300,000 shares at 22 cents brings our total up to $75,600. And just as we discussed on Tuesday, then, when we report, or excuse me, when we declare dividends, we have to report the cost of that. That eventually, when we close our books, is going to be subtracted from retained earnings. And we have to, on our balance sheet, report that we now owe our stockholders a total of $75,600. The next important date then would be the date of record. Again, we know there's no entry required for that. And so we don't show that here, but somewhere between April 30th and July 1st would be the date of record that determines who's going to receive these cash dividends. And now on July 1st, we're actually going to pay them. So we'll no longer have that liability, and we're going to use cash to pay them. Everybody good so far? Okay. Now on October 31st, they declared semi-annual dividends of 60 cents on the preferred stock. So we already know that piece. And then they report another 11 cents per share on the common stock. And then they do a stock dividend. So that's kind of weird. Not very realistic that a company would do both of those things at the same time, a cash dividend and a stock dividend. But this is our practice. And so we will assume that that's what actually happened. So 300,000 shares that are receiving 11 cents per share. So the first thing we're going to record is the value of that cash dividend, and that we owe that. So 16,000 shares at 60 cents plus 300,000 shares at 11 cents is $42,600. But now we need to report the cost of that stock dividend that was declared. 5% based on what we talked about in the last exercise, that is a small stock dividend. And so we're going to use the market value of the shares as a proxy for the actual cost or value of that dividend. So we have 300,000 shares outstanding, and we are issuing a 5% stock dividend, 5% of 300,000. 15,000 shares that we will be issuing when we get to the distribution date. Does this stock have a par value? So if we scroll up here, we know that the par value is right now $50 per share after that stock split that happened back in January. So for those 15,000 shares that we are going to issue, the par value is $50 per share. And so that is going to be common stock distributable or stock dividends distributable. And then the rest, so they told us that the market value, the market value of these shares was $56. The first $50 of that represents the par value. So the last $6 is the additional paid-in capital. And so on October 31st, when we declare that stock dividend, we need to report the total cost or the total value. That's the $750,000 plus $90,000, or $840,000 is the total value. The par value, as we said in the last exercise, is now distributable, and the rest of it is additional paid-in capital or paid-in capital in excess of par. And you should be able to do the December 31st entry at this point as well. So when we pay the cash dividends, we'll no longer have that cash dividends payable, and we'll be using cash to pay those. And at the same time, we will be distributing that common stock, so it's no longer distributable. And we are going to add it, move it into the common stock account. So the end result is our retained earnings goes down by $750,000 whoops, sorry. Not that number. Goes down by 840,000. That's the total amount of that stock dividend, plus the 42,600. So the end result is our retained earnings goes down by 882,600. Our assets go down by 42,600 when we use the cash to pay the dividend, and our contributed capital goes up by 840,000. So the total change to our balance sheet is only a reduction of 42,600 in our assets, in our equity, and the stock dividend piece is just a reclassification out of retained earnings into contributed capital. Any questions? Again, if you do have questions, you're welcome to unmute or to.
Excuse me, can you scroll up to the very top for a quick second?
I can.
Thank you.
So you're good?
Yeah, I'm good.
Okay, thank you. All right. So we'll keep going. And I'm going to go back to the PowerPoint just for a moment. So we can talk about treasury stock. So I've mentioned treasury stock on Tuesday. I mentioned it again today. Treasury stock represents stock that the company had issued, but is no longer outstanding. How did that happen? Well, they repurchased it on probably on the open market. They just go, into the market, just like you or I would. If we wanted to buy stock in a company, you contact a broker and say, hey, I want to buy some stock. It's probably on a bigger scale than what we would be doing. We already talked a little bit about why a company might want to repurchase treasury stock so that they had it available for stock dividends or for stock splits. But you can see a few more reasons here that they might want to incentivize their employees by making them owners in the company. We've talked about in an earlier chapter that one of the problems of the corporate form of organization is that separation between ownership and control of the company. And so one way to help fix that principal agent problem that we've discussed is by making the employees also owners in the company. And they can do that by either selling stock to their employees at a reduced cost or by giving it to their employees as a bonus or part of their compensation package. We've talked about how issuing more stock can make the price of the stock come down. So it stands to reason if we pull in some of that stock by buying treasury stock, that we would expect the price of the stock to go up. There's nothing inappropriate or unethical about that. It actually does increase the value of the company to the stockholders that remain. And so it's perfectly legitimate to buy back their own stock in order to support or to prop up the price of that stock. There's nothing wrong with that. For our purposes, we are going to be using the cost method for reporting treasury stock. And so every transaction is going to be reported in the treasury stock account. Every transaction will be reported at what we paid for it when those shares were repurchased on the open market. So let's go back to our exercises. And our next exercise is related to, of course, treasury stock transactions. Spray Company Incorporated develops and produces spraying equipment for lawn maintenance and industrial uses. On March 9th of the current year, Spray Company reacquired 62,000 shares of its own common stock at $51 per share. And stop right there and we'll journalize that transaction. So when we buy back our own stock, just like when we buy anything, we're going to use cash to do that. And so how much cash did we spend? We bought 62,000 shares and we paid $51 per share for them. 62,000 shares at $51 per share. the total cost of those shares was $3,162,000. Now remember, those shares are still considered as issued, but they're no longer outstanding. And so we don't do anything to the contributed capital accounts. We don't do anything to the common stock account. We don't do anything to the additional paid in capital. Instead, we report this in the treasury stock account. So we report it at what we paid for it. You'll notice that treasury stock has a debit balance. It has a normal debit balance. It reduces our outstanding equity. And so it's going to be shown as an offset or a reduction. And when we go back to the PowerPoint, I'll show you what that looks like on a balance sheet. So it actually reduces our total equity. Normal debit balance. On June 9th, then, of those 62,000 shares that we bought, on June 9th, we sold 48,000 of them. Now, it's nice to think that, hey, we made money selling those shares because we paid 51 for them and we sold them for 60. But from an income standpoint, no, this is not something that shows up on our income statement. We don't get to claim that we made money by selling our own shares. It is a balance sheet transaction. It does not affect the income statement. And so when we sold those shares, we received cash for them. So 48,000 shares we sold for $60 each. Our cash is going to increase by $2,880,000. Now remember, I said we're going to use the cost method for accounting for our treasury stock. So that means this treasury stock account, we know it's going to go down because we just sold 48,000 of those shares. So we know the treasury stock, there it is. We know that that treasury stock account is going to go down, but it has to go down because we use the cost method. Everything that happens in that treasury stock account, we're reporting at $51 per share. The shares, if you want to think of it like this, the shares that are in that account are worth $51. And so 48,000 shares at $51 in the treasury stock account, we need to report that at just $51 per share, or $2,448,000. Now, looking at this entry, even if we didn't see that blank third line, we would know that we can't be done. And the reason we know that that's not a completed journal entry is, of course, because the debits and credits aren't equal. So the difference between those is $432,000. So the way I described it, that's kind of the money that we made by selling these shares for more than we had paid for them. But again, it doesn't hit the income statement. We don't show that as a gain on selling our own stock. We don't ever show gains and losses related to stock transactions of our own stock on our income statement. And so instead of it being a gain, we're simply going to report it as additional paid in capital. And it looks very much like any additional paid in capital on our preferred or common stock. It has a normal credit balance. It increases our equity. We just don't run it through the income statement. Okay. So we had 62,000 shares of treasury stock. We now have sold 48 of those. And we have 14,000 shares of treasury stock left. On November 13th, we sold 7,500 of those reacquired shares. So the 14,000 we had left, we sold another 7,500. So again, we have to show in the cash account, the actual cash we received, 7,500 shares at $54 is $405,000. We know again in the treasury stock account, we have to report it at what we paid for those shares, $51 per share. And again, in one sense, we made money on these shares because we bought them for 51 and we sold them for 54. The additional change to our balance sheet then is $22,500, and that's going to be paid in capital from the sale of the treasury stock. Letter B, what is the balance in paid in capital? So we had 432,000 here plus another 22,500. Adding those two pieces together, the total is 454,500, and that is of course a credit balance. That account has to have a credit balance in there. It cannot have a debit balance. What's the balance in our treasury stock account? Well, there's a couple different ways we can go about this. We can take the original debit and subtract the two credits. That's fine. Or we could say we had 14,000 shares left and we sold another 7,500. So we have 6,500 shares left. And they're accounted for at cost at $51 per share. Oops. And so we would have $331,500 left, and treasury stock always has a debit balance. So you could get to that number either way by kind of doing a T account analysis of this minus this and this, or by recognizing we have 6,500 shares at $51 in that account. And how will the balance in the treasury stock be reported? It is a deduction from our stockholders' equity. Okay. It appears in the equity section, but it reduces, because it has a debit balance, it reduces our stockholders' equity in total. Okay, so those are our treasury stock transactions. Any questions on that? Okay, so the key is to remember that we always report that treasury stock at cost in the treasury stock account, and that we do not report any gains or losses. We don't make money by dealing in our own stock. All right, and we'll keep going. So there's more than one way to report stockholders' equity. We're going to look at an example here in just a moment. We may show changes in our retained earnings and paid in capital on separate statements. So we're going to be looking at, in exercise 10, a statement of stockholders' equity that shows all of the changes that happened. We've known about the statement of stockholders' equity since chapter 1, but up until this chapter, we've only been looking at two accounts, common stock and retained earnings. Now in this chapter, we've learned about several other types of accounts that might appear there if the company has them. Preferred stock, additional paid in capital on the preferred stock, on the common stock. We've now seen treasury stock. We've seen the stock distributable, the common stock distributable or stock dividends distributable. That also could show up on a balance sheet if we've declared a stock dividend but haven't yet distributed it at the time that the balance sheet was prepared. So lots of other accounts that we've learned about in this chapter that are going to or could appear on a company's balance sheet. And so we're going to look at the different ways of reporting stockholders' equity. And I will tell you which one I prefer, just because, for no particular reason. But really the difference in these two methods is what we do with that additional paid in capital. So it can be reported for the preferred and for the common stock separately and for the treasury stock, but it can all be lumped together. I'm not a fan of the lumping it together. I prefer to have more detail. But let's look at our examples here, and then we will go to exercise 9. So this example, you can see, I get my little pointer here so I can see what I'm pointing at. So you can see right here that this is the paid in capital in excess of par for the preferred stock. And here's for the common stock. And here's some for treasury stock. And so all of that is listed separately. And then down here at the bottom, we see the offset for the treasury stock, that reduction in our total equity, because we still have 600 shares of treasury stock. And so that's one method. The second method looks a little cleaner because you have fewer lines, but it also provides a lot less detail. And so in this case, we have the additional paid in capital right here. And it's the same dollar amount. The bottom line is the same, but we have lumped together as additional paid in capital the part that's for the preferred, for the common, and for the treasury stock, all in that one number. So you may prefer one or the other. Either one is perfectly acceptable for a presentation of the equity section of a balance sheet under GAAP. So I don't know that there's a better or worse. I just like the idea of being able to see the various components separately. Okay. So what we're going to be doing is a statement of stockholders' equity that's going to show each one of the columns from the, or each one of the rows, excuse me, from the balance sheet. In the equity section will have its own separate column, so we can see all of the changes that happened to all of those equity accounts on the balance sheet throughout the whole period, the whole year of the financial statements. But you can see, that there is the option of showing just the retained earnings piece. And so this is kind of a microcosm of what we're going to do on the stockholders' equity statement in exercise 10, that we show, here's what we had at the beginning of the period. So here's our beginning balance, and here's all the changes that happened. We made some money, so we added that, and we declared some dividends, so we had to subtract that. You'll notice these are stock dividends, but they could just as easily have been cash dividends or some of both. And so that addition of the income and subtraction of the cost of the dividends makes a net increase, and then we show the bottom line. This is what's going to show up on our balance sheet at the end of the current year. So we started at 245, we ended at 350. You can see that on the balance sheet. And this statement says what happened, why did it change? The stockholders' equity statement is going to be every equity account. How did it change? Let's go to our exercises then. Move on to exercise 9. And we're looking at the stockholders' equity section of the balance sheet. So we've just seen in the PowerPoint what that would look like. We are asked to use method 1. So that's the one that I said I prefer, because you can still see the detail. You can see where that additional paid in capital came from. And so that's what we're going to be using here. Specialty Auto Racing Incorporated retails racing products for BMWs, Porsches, and Ferraris. The following accounts and their balances appear in the ledger of Specialty Auto Racing on July 31st, the end of the current year. We are asked to prepare the stockholders' equity section of the balance sheet as of July 31st. And so this is not a full balance sheet. This is not a financial statement. This is one part of a financial statement. But we still want to label it, of course, with the heading to let people know here's what we're reporting on. We start with our paid in capital, and we can see that this company has preferred as well as common stock, and they also have some treasury stock. So we're going to be reporting the preferred stock. The first number that we report is the par value of that preferred stock. And it's right here. So $7.2 million we have in par value. You'll notice that we disclose all of the descriptors of that preferred stock. So the stated dividend rate is 1%. We have the par value. We know how many shares are authorized. We know how many shares are issued. And if necessary, we would also say how many shares are outstanding. If it doesn't tell us the number of shares outstanding, we can make the assumption that all the shares that have been issued are still outstanding. And because we're using method 1, we're next going to show the additional paid-in capital, or the paid-in capital in excess of par for the preferred stock. We will report that separately. And so if we add those two together, 7584, that is the total of the paid-in capital related to preferred stock. Preferred stock is always going to be listed before the common stock. And because we're using method 1, we're going to have separate amounts for the common stock. This would be the par value. We don't even really have to look up at the given information, because from what I've told you, you know that this common stock account must have in it the number of issued shares, 280,000, times the par value, which is $36. So we can check that number up here, up here, but we didn't really need to be told that, because we already know it must be the number of issued shares times the par value. That has to be what's in there. We have the paid-in capital in excess of par for the common stock of $420,000. And when we add those two together, we'll have the total paid-in capital for the common stock. And then, as we saw on method 1, the next piece that we are going to add in before we get to the total for paid-in capital is going to be if we have any paid-in capital from the treasury stock. And we do right here. $340,000 in paid-in capital on the treasury stock. Whoops, what was that number? Not 420, that was the other one, 340. So now if we add together the paid-in capital from the preferred, from the common, and from the treasury stock, we have our total paid-in capital. And to that number, we will add the retained earnings to get our total equity. There's our retained earnings, 71,684,000. And add that to the total paid-in capital. And then the final step is to subtract our treasury stock. So we know that this treasury stock has a debit balance. It's a reduction in our equity. We should show that as a negative. Remind us to subtract. It's not uncommon to also say over here, less treasury stock, to remind us to subtract. And then the bottom line is our total stockholders' equity. Any questions about that? So again, this is method 1. The difference between this and method 2 would be simply these three: excess of issue price over par, excess of issue price over par, and then the paid-in capital from the treasury stock. Those three could all be added together and reported on a single row. Bottom line doesn't change, though. Our total stockholders' equity would still be the same. All right, if there aren't any questions, I will keep going. And so In exercise 10, which is not our final exercise, because remember, we need to go back and do exercise 1. But in exercise 10, we're given some equity accounts in T accounts. We can see the transactions that happened during the year, and we're asked to prepare a statement of stockholders' equity for the year ended December 31st. So I just want to scroll down here so you can see the format. Whoops, there we go. So you can see the format of that statement of stockholders' equity. It looks, so this column, the retained earnings column, includes all that information I just showed you in the PowerPoint on that example. Beginning balance, what changed, ending balance. The statement of stockholders' equity then just includes a separate column for each one of the rows that appears on the balance sheet. The first line is always going to be, here's what we had at the beginning of the year. And the last line is going to be, here's what we had at the end of the year. These values that appear in that last line are what appears on the balance sheet. And so we prepare the statement of stockholders' equity between the income statement and the balance sheet, because this is how we know what to put in the equity section of the balance sheet. So for the common stock column, if we go up to the T account for common stock, what happened in that account? Well, we started at 4.8 million. We sold some additional shares, and the par value of those shares was 1.2 million. So that added to our balance, and that's where the ending balance came from of 6 million. So we can report beginning balance was 4.8 million. Whoops, how did that happen? The beginning balance was 4.8 million. We issued additional 30,000 shares of stock with a $40 par value. So 30,000 shares at $40 added $1.2 million worth of paid in capital to that common stock account. Then we're going to look at the additional paid in capital, or the paid in capital in excess of par. It started with a balance of 960. When we issued these shares on April 14th, we said this was the par value, but we didn't sell them for just 1.2 million. How much did we sell them for or issue them for? 1.5 million. It's the 1.2 was the par value, plus the extra 300,000 brings us to the balance of 1,260,000. And so you'll notice that the 1.2 million plus the 300,000 makes up the total of that transaction of issuing those shares, 1.5 million. So in that one transaction, we increased our equity by $1.5 million. Let's look at the treasury stock. So you'll notice that this transaction happened on August 7th. What that means is at the beginning of the year, we didn't have any treasury stock. And so we should enter a 0 there. And we know that treasury stock is a reduction to our equity. We can see in the T account, we know that it has a debit balance. And so we're going to actually show that as a negative here because it reduced our equity. I'm going to show it as a negative over here. In our actual accounting records, we don't use negative, we use debit and credit. And so the treasury stock account has a debit balance, but that does reduce our equity. And so on this statement, we want to show that as a negative. And it does explain that here, but that's not just for the software. That is the way we would always show it. If it's a reduction in our equity, we want to show it as a negative on this report or on this financial statement. And now let's look at the retained earnings. So here's our beginning balance. I'm just going to copy that down here. And what happened during the year? Well, apparently we paid dividends, quarterly dividends every 4 months, or excuse me, every 3 months, 4 times a year. We paid dividends of $69,000. That's a total of $276,000, $69,000 4 times. That is a reduction in our equity. We're going to show that as a negative. Those represent earnings that we did not retain. We made the money, but we paid it out in the form of dividends. Here, when we closed our books at the end of the year, we had income of $3,780,000. And of course, making money increases our earnings, increases our retained earnings. And so we're going to show that as a positive. So we have our ending balance. We don't even have to calculate that. It was given to us. Beginning balance plus income minus dividends should equal that amount that's given here at the bottom of the T account. And now we can add across to fill in the rest of these boxes in the total column. And then we can add down and we can add across to check ourselves. And so that is a statement of stockholders' equity. It accomplishes exactly the same thing as the statement of stockholders' equity that we've been doing since chapter 1, but now we know a little bit more about equity. And so we don't have just the 2 columns, common stock and retained earnings. In this case, we've added in the additional paid-in capital and treasury stock. And certainly a company could have preferred stock and additional paid-in capital on the preferred stock. It could have been paid-in capital on the treasury stock. So there could be, 3 more columns on this report. But this is how we find the balances that are going to go on the balance sheet at the end of the year. Any questions? All right, well, let's go back to exercise 1, and I'm going to go to my PowerPoint. And so exercise 1 is, as it has been in the last several chapters, one way of using the information that we're learning to analyze a company, to help us make a decision. Because for about the 50th time this semester, I will just mention the whole reason we do all of this stuff is to help people make decisions. And so in each one of the last several chapters, we've had at least one way, one tool that we can use to make a decision about a company. So who would want to make a decision about a company based on earnings per share or EPS? Well, one group of people that might want to know is the investors. We're putting this money into your company so that you can use it to make money. Well, how are you doing at that? We can look at their income statement and see how much money they're making in total. But if you're an investor, you want to know, yeah, but how much of that is mine? How much of it is based on my investment in your company? And that's where the earnings per share calculation comes in. So and by the way, I need to say there is not necessarily any relationship between earnings per share and dividends per share. Okay, so earnings per share is how much the company made, but it's not necessarily how much they paid out. Also, if the company has preferred stock, remember preferred stock has preference in order of dividends, but they have that stated dividend rate. And so there's, as we talked about on Tuesday, there's a cap on the earnings that belong to the preferred stockholders. And so at the bottom of this slide, you can see the calculation that we're going to be using for earnings per share. Net income, which comes from the income statement, minus preferred dividends, which is going to actually come from the cash flow statement, or from the statement of stockholders' equity, you might be able to see it there as well. And then the denominator is the average number of common shares outstanding. So we've looked at average inventory, average accounts payable, average accounts receivable. The average number of common shares outstanding is probably not going to be calculated in that same way, where we have just the number from the beginning and the end of the year added together and divide by 2. We would actually do a weighted average based on how long those shares were outstanding. If that number changed during the year, if the company issued new stock, or if they repurchased treasury stock, we would want to take into account when that happened during the year. For our purposes, though, in exercise 1, they're going to tell us how many is the average number of common shares outstanding. But I just want you to realize that that is not a straight average, or what's called an arithmetic average, in the same way that we've been using averages for other financial analysis tools that we've looked at. So we would want to have the weighted average. We'd want to know how long those shares were outstanding if it changed during the year. So let's go to our final, whoops, there it is, final exercise for this chapter. And this is exercise 1. Financial statement data for the years 2015 and 2016 for Black Bull Incorporated follow. So we're given their net income. We're also given the amount of their preferred dividends. And for each year, we're given the average number of common shares outstanding. And so let's start with the calculation for 2015, because it's the one that's on the left. Get my writer up here. And so the numerator portion of that equation, the company made in 2015 $1,538,000. But out of that $1,538,000, $50,000 of it belongs to the preferred stockholders. Then we need to say again, there's not, it's not necessarily that those dividends were paid out. It might be that we have dividends in arrears, but of the money that was made, the $1.5 million, $50,000 of that belongs to the preferred stockholders to pay the dividend that we have, promised them, I guess. And so, once we subtract that $50,000, it tells how much earnings is left that kind of belongs to the common shareholders. Now, this company may pay dividends, they may not pay dividends. That's not relevant to this exercise. We're talking just about the earnings. How much money did they make, regardless of whether they paid dividends on their common shares or not. And in 2015, there were 80,000 common shares outstanding. So the company, after they pay the preferred stock dividends, they have $1,488,000 left. And if we divide that by the 80,000, by the 80,000 common shares, we get earnings per share of $18.60. So what do we do with that? How do we know if that's good or bad? Well, one thing we don't know here is how much each share cost. And so there is a calculation that will give us some information about the earnings per share, or excuse me, about the strength of this company, the market strength of this company. And it's called the price to earnings ratio, or I should probably put this here, PE ratio. And so the price to earnings ratio takes the price, the market price of that stock, and compares it to the earnings per share. And that gives us a sense of how strong, or what investors think about this stock. So within stock trading, we can classify stocks as being either growth or value stocks based on that PE ratio. Generally speaking, a PE ratio of greater than 15 is seen as a growth stock. So they don't have a lot of earnings right now, but but the price of the stock is pretty high. That tells you that investors are pretty confident that this company is growing, that they're going to have more earnings in the future. If you haven't already, go ahead and do the calculation for 2016. So the company clearly is growing. So their earnings went up and their number of shares also went up. So maybe they sold some more shares in order to be able to afford to grow, to get the cash that they needed to expand, possibly. And what we're calculating here, knowing that the company's growing, are they making wise use? We sold an extra 35,000 shares this year. Did they do a good job with that extra capital that they had to invest? And you can see that their earnings per share did increase. And so that would be seen certainly as a favorable outcome. And we can then plug that into the PE ratio calculation to see what's happened to their PE ratio as well. Any questions? So that is the end of our coverage of chapter 12. Any questions? Anything else I can help you with today? I'm going to stop the recording.